Let's go.
Hedge funds. Would you want them to be in charge of your mortgage or your credit card? It doesn't seem like it. You wouldn't want these flighty, fast-moving, highly leveraged investment speculators in charge of something like a pension, a long-term investment fund, something fundamentally important. And you would say you probably wouldn't want them in charge of money dealing. But recently, they have taken on an outsized role in distributing money throughout the financial system. And we're going to talk about that next and whether or not that's a good idea. But first, let me know if you're watching this video. If you are watching this video, did you know that you could also listen to it as a podcast? Yes, that's right. You'll find Making Sense only on Verbal and Apple and Deezer and iHeart, TuneIn, Castro, Google, Spotify, Pandora, Breaker, Castbox, Podbean, Stitcher, Player FM, Podchaser, Pocket Cast, SoundCloud, Listen Notes, Amazon Podcasts, and Podcast Addict. All right, so now I'm joined by Jeff Snider, a man who doesn't listen to podcasts, but he is the head of global research for Alhambra Partners. Jeff, we're going to be talking about an article you wrote about a week ago, and you start out saying, could low repo haircuts on US Treasury collateral actually be a source of potential danger? A couple paragraphs in, you start talking about a repo haircut. We're going to start out going ABC basics before we get to the bigger picture. So what is a repo haircut?
Quite simply, a repo haircut is the protection that the cash lender gives for themselves in order to engage in a secured interbank lending transaction. Remember the motivations on each side. The cash lender wants to be able to lend his cash at as little or no risk as possible. And the best way to do that is if I lend you cash, you give me some form of financial security or collateral, so that if you default on the loan, whether it's tomorrow or a month down the road, I can sell your security and get my cash back. I'm very much protected. Now, the price of that security might move between today when we make the loan and even tomorrow when you default and I have to liquidate your asset. It might be that, a really risky security in a really uncertain market environment, it might be the case where the overnight move is substantial. So I have to factor in how much leeway, how much margin am I going to give you on your security, depending upon the liquidity and credit characteristics of the underlying asset. And that's really all a haircut is. The haircut says, you give me a piece of junk, I'm going to have to give you a large haircut. So you want to borrow $100 from me? Well, you give me $100 par value of junk, I'm not going to do it for you. But if you give me $120 worth of junk, I'm going to do it because that gives me enough leeway so that if the price of that asset falls tomorrow, I'm relatively certain that I'll be able to still sell it and get my money, all of my money back, not lose a penny on what's supposed to be the safe transaction. And so inversely, if you give me a really high quality piece of collateral like a US Treasury, especially a US Treasury bill, I'm going to give you credit for almost as close to the par value as possible. Maybe only a haircut of around 1% or so. Just, to give me, again, a little bit of margin in case the value of the asset moves a little bit overnight and you default tomorrow and I have to factor in a less valuable asset. So the haircut is really a function of the characteristics of the assets being pledged. And treasuries, of course, or any of the major sovereign debt assets are going to have very low haircuts because there's, number one, they have they have the best characteristics embedded within them, but also they have the most dependable markets, which is another factor too, because you have to think, is there going to be a market tomorrow when I sell this thing? Everything looks great today. Going back to our junk example, if I'm not really certain about the ability to sell the asset into a marketplace that's functioning, then the haircut needs to be adjusted accordingly. So U.S. Treasuries, low haircuts, low risk, risk-free profile, as well as dependable liquid markets.
That clickety-clack that you're hearing right now is all the people heading to the YouTube comments section mocking us for talking about haircuts.
Yeah. That's true, absolutely. The irony here.
The article in question, the essay, was posted on the 23rd of April at Real Clear Markets. It's a great one, folks. I encourage you to read it. The title is A Profound Statement in the Ongoing Saga of Shadow Money. And so, yeah, when we get a loan for a house, 20, 30%, that's the haircut, the loan, right? In case we get fired, we're unable to make good on the mortgage, that bank will seize the house and sell it, and hopefully that 20% cushion that they have will cover the cash loan that they extended us. Same thing with cars. And then in the repo market, which we didn't define as a repurchase agreement market, where we put up capital market securities like bonds, but sometimes also stocks and mortgage-backed securities, and what else? Agency, federal government agency paper, all manner of assets, but usually US Treasuries, right? That's the most pristine, stable market that you can get the smallest haircuts on. Okay, good. I think I understand that. What about from the other perspective, from the borrower? You tell us here that this is a great deal for them because they only need to put up $1 to $2 in order to get $100 worth of cash. Can you explain how that works?
Yes, let's assume you're a hedge fund and you have a prime brokerage relationship with whatever prime broker. Doesn't really matter. They're all pretty much the same anyway. You think, well, I want, being an investor, being a hedge fund, and seeking to maximize returns, the way you maximize returns is through leverage. And it actually turns out haircuts are a form of leverage. If you think about it from the opposite perspective, what you're actually doing is, because you're buying a US Treasury, which really doesn't yield all that much, but if you borrow the funds in the repo market and say, okay, I'm going to buy $100 of a US Treasury note, I'm going to put in $1 because that's the haircut that the cash borrower wants for the security, and I'm going to borrow the other 99 from the repo market. Essentially, I've put in $1 for $100 in assets, which means I've used 100 to 1 leverage. And because this is a safe asset with a very low haircut, that offers me in this particular situation the maximum amount of leverage possible. So even if the haircut's 2%, for example, that's still 50 to 1 leverage. I put in $2 of my own money to cover the haircut. I borrow the rest from the repo market using the security that I just purchased as collateral for the borrowing. And then we roll this trade over day after day after day after day. And so long as the haircut doesn't change, or the counterparty, the repo market doesn't completely shut down like it did in October 2008, we can do this indefinitely because treasuries are not only low haircut, they're easily used in repo. In fact, you can actually enhance your returns through other ways, which we won't get into here. But suffice to say that low haircuts means high leverage for certain types of transactions.
The next step in our journey here is the arbitrage, where you can make a return on some sort of small spread, likely, that mathematically or logically should not exist. There's a disruption in the market. And the arbitrage is that you're going to be able to go in, and when the market rights itself for logical or mathematical reasons, you will make that spread. But as we were just talking about, maybe the hedge fund isn't in the business of being poor. Maybe it's in the business of making a lot of money, and that spread is a small one. So they're looking to make a big return, and what better way than with leverage? What would be an arbitrage example? I guess one arbitrage example is if oil prices were extremely high in the future, but very low in the present. You would buy low and sell high. You would sell the futures price, and you would figure out it only cost me $5 a barrel to store this, and a year from now the barrel of oil is supposed to be $100. I'm completely exaggerating. And you would say, this is a great deal. I'm going to make good on this arbitrage opportunity, but you know what? It's such a good deal. I'm going to go and borrow as much as I can to make as much as I can, because it's almost a certainty. And that's where our story heads next, but in the treasury market. Can you tell us the arbitrage opportunity over there?
Well, yeah, and let's start from your example here, which is that there's this really good low risk. I mean, that's what arbitrage means: low risk profit opportunity. And if you can see it, that means everybody else can see it too. This is not some hidden mathematical black box type of thing. And that's how markets are supposed to work. An arbitrage opportunity opens up, everybody jumps on it, and it closes. So these arbitrage things, these arbitrage opportunities should be exceedingly rare. As you pointed out, it's not something you should see as a steady. You can't make a business off of a single arbitrage. You have to hunt for them everywhere else because the sharks circle and they disappear. They appear and they disappear, almost like matter and antimatter colliding in random quantum physics. So we have these arbitrage opportunities that do appear sometimes and then stick around, and it's usually because of something else, some problem in the system whereby everybody can see this arbitrage opportunity. But if it's sticking around, then that means that not everybody must be able to take advantage of it. And a very good example that we talk about all the time is a negative swap spread. That was sort of an arbitrage opportunity. Now they've become normal, but back when they first happened, it was like, wait a minute here. The swap price is below the same maturity treasury nominal yield. Dealers should be jumping all over that spread to make money, and they never did, which suggested that here's an arbitrage opportunity. People aren't taking advantage of it. They must be constrained in some fashion to prevent them from trading it back into its normal position. Now, in the futures market, if there's any arbitrage opportunity, so any spread between the spot price and the futures contract price, that's called a basis trade. So that's what we're going to talk about here, is something called a basis trade, which is an opportunity whereby the spot price of whatever asset, in this case it's going to be US Treasuries and US Treasury assets, and the futures price of the US Treasuries diverge. They create a basis trade opportunity for anybody to take advantage of.
But they always diverge. What do they diverge more than to? Is it the rate of return on a short-term bill? What is that divergence?
You're talking about what is the basis trade?
Well, I'm just saying in the future, the price will be different than the price today. Aren't they?
No, what we're looking at is the mathematical calculation of what does the futures price say about the spot price.
Yeah.
And if there's any kind of difference there, it becomes an arbitrage, because over time, if you simultaneously trade this arbitrage, what happens is you're never going to lose money. And that should never happen. So if you think the present value of the spot price is X dollars in the future, and the futures price doesn't reflect that number, then you've got some kind of opportunity trade away. Because in this basis trade we're going to talk about, where the futures price was, completely different, it wasn't valued the way that the market should have valued it. It created the opportunity where you could short the futures contract, go long the spot price, which is the cash bond, and you could never lose, because over time those two things would converge together. Especially since if you're buying the cheapest delivered treasury, that's the asset you're actually going to deliver, being short the futures contract. So whether whether the price moves, the spot price moves over time doesn't matter, because you've already got the futures price locked in. It's a clear arbitrage opportunity where you're taking advantage of temporal disruptions in the way that the futures market it's not working the way it should.
And we don't expect to see this because there are entities out there. You called them sharks before, but we're going to call them money dealers. There are entities who are on the hunt and who have the ammunition and the desire and the ability to smooth out these disruptions and these ripples of arbitrage. The money dealers are supposed to be doing this, and we want them to do that. But we're going to be talking about that. No, they're not doing that. But here, so tell us a little bit about the money dealers and their role. They're the ones that are supposed to be doing this.
Yeah, I mean that's really they police these markets, whether they're futures markets or any market, including repo. And what they're doing is they're looking for these arbitrage opportunities to pick up a couple pennies along the way, because that's kind of what they do. They make markets and they look at these various opportunities and these various trades, and they say, look, there's a free money here. We don't expect it to be around very long, because we know everybody else is going to jump on it. But it's let's pick up our couple pennies and let's do this in every market. And the way it becomes useful, it's a useful fundamental property, because it means that markets become predictable, become flexible, become very liquid, because we know that there's never going to be these kinds of frictions and inconsistencies that we're seeing when we talk about a basis trade and arbitrage opportunity, which is sort of a thing that it's a disruption in the marketplace that can cause all sorts of problems. And that the fact that dealers are there making sure that those arbitrages never really, they don't stick around very long, and these markets are very hierarchical and dependable and predictable, that's a good thing. We want these things to happen. But when an arbitrage or a basis trade shows up that lingers around or actually grows and gets bigger, you gotta think in the back of your mind, what's going on? There's something not right here. Where are the dealers? Why aren't the dealers taking advantage of it? And that, to me, is really the story. Whether it's we talk about swap spreads or here in the basis trade, it should be, why is this basis trade there to begin with, rather than, oh my God, a bunch of hedge funds jumped all over it for many, many years. It's, wait a minute, how do we have this massive, it wasn't really a big thing, but the fact that it stuck around or it shows up at specific times tells you a lot about cause and effect.
Audience, Jeff, that's the part that Jeff wants to get to, is the why. Why is this happening? Why are the dealers not participating? But before we get to that part, we're just going to set the scene some more, because someone did step in. The dealers should be doing this arbitrage, but they didn't, and therefore there was an opportunity for someone else to take over the dealer's function. So we'll just set the scene some more before we get to the why. Let me read this quote here.
Yes, I want to get to the end. Right? jump to
that's the best part.
Let's get to the end. No.
Let me just set the scenery, put the, where all the sofa where it's supposed to be, the bookcase, and then we'll solve the murder mystery at the end. Okay, quote. But, and this is crucial, what if dealers in the presence of this basis trade arbitrage are unable or unwilling to take advantage of it? Put another way, what happens if or when dealers are constrained? And you're going to tell us about that someone stepped in. But you know what it reminds me of? And you mentioned that word just maybe a couple minutes ago. You said hierarchical, in order, structured. That's what it used to be before 2007, Jeff. I remember seeing your presentation in Toronto in 2018 with Macro Voices. That was the focus of your presentation. You were talking about the different rates, federal funds and LIBOR and the repo rate, and how they should be hierarchical. But after 2000, or starting in 2007, the hierarchy was destroyed. And we didn't see the dealers step in to fix the system, the order, put the planets back into the order they're supposed to be in. And here we are again, another example, like you mentioned earlier with swaps. Here we go again. So, but someone did step in, the hedge funds.
Yes, and so look, we have a basis trade opportunity that normally dealers would police and they wouldn't linger around very long. And again, it's not a huge spread. It's not like you're making 10% on a trade. It's we're referring to a specific paper. What they found is that at most it's 30, 40, maybe 50 basis points, which is where the leverage coming in from the Treasury repo and haircuts comes in, because that signifies or incentivizes a certain type of investment vehicle to take advantage of what dealers are not. So if you're a hedge fund, which is why we've been talking about hedge funds, because obviously, spoiler alert, the hedge funds are the ones who took advantage of this basis trade and haven't historically in the past. And before we go any further, let's state that too. This is not something that just showed up over the last couple of years, and this has never happened before. This is something that certainly that we have seen, and we have actually talked about this before. But in the specific paper that we're talking about, they observed the same basis trade behavior at very specific times going back 25 years. The first example was LTCM and the Asian financial crisis that we know of as the first regional dollar shortage in the Eurodollar system. Again, dealers constrained, basis trade, hedge funds show up. The same stuff kind of happened 25 years ago. It also showed up in the opposite way, where the basis trade was flipped around and the futures were overvalued rather than undervalued rather than overvalued. That was 2008, around the time of Lehman Brothers. Again, dealers constrained, arbitrage opportunity, hedge funds step in. So what we're talking about specifically now is something that began around early 2018, late 2017, where the futures contract became overvalued relative to the spot treasury price, which dealers did not take advantage of, and instead left open this opportunity for hedge funds to step in by going short the futures contract and long the cash bond, which meant they were borrowing the funds to go long the cash bond in the repo market, taking the leverage from the repo haircuts to add value in their terms to this arbitrage transit. So low risk, high return opportunity because of the repo leverage. And all of it put together, all of it put together because this arbitrage basis trade opportunity not only existed, it continued for a very long time.
Jeff, am I right to focus on that the financing for this trade was done in the repo market? Am I right to raise my left eyebrow in some slight concern on that?
Not necessarily, because let's assume that the dealers were going to take advantage of this opportunity to begin with. They would use the repo market too. Now there is, it's not the same when a money dealer goes in the repo as a hedge fund, because a hedge fund might go through a dealer. There are there's potential for frictions and changes and sort of those kinds of things, but I don't necessarily think that's the part we want to focus on. I think other than the fact that, look, the repo market is connected to all of these things, as it always has been, because what we're really talking about here, which is when we get back, I think it was in the title of the essay, was that, look, this is warehouse activity. That this is what dealers normally do. And one of the ways that they finance warehouse activity is through these kinds of arbitrage.
What is warehouse activity?
Warehouse activity is what money dealers, their primary task, their primary dealer task is to buy assets that are auctioned off in the primary market. Not just the US Treasury, not US Treasuries or from the government, but even, offerings from companies or governments, municipal bonds, whatever it be, agencies, Fannie and Freddie. We want these banks to buy what's on offer from these issuers, and then store them so that they can sell them to the public over time. Because if you had a free-for-all type of no dealer auction process, the government might show up tomorrow and there's nobody there to buy the assets. So we want financial institutions who have an incentive to go to these primary markets, go to these auctions, to buy up all whatever's being offered and then some, store it for a time, and then sell it off to the financial public. And that's what warehousing activity really is. And that gave rise to all sorts of things, including proprietary trading. That's where proprietary trading came from these warehousing activities, because dealers have to be compensated to take on risk, right? If you're buying a treasury today or a junk bond, for example, and you're selling it off over time to the public, you have risk because you don't necessarily know what price you're going to be able to sell it off at. And there's also other considerations too, especially when we're talking about US Treasuries. Sometimes the dealers might not just be warehousing their treasuries, they're using them as well. The repledging, reuse, and the rehypothecation that we talk about all the time. So warehousing isn't simply, creating a stock of inventory of bonds. There's all sorts of functions that go along with it. And a lot of warehouse financing is conducted in the repo market. So that's one reason why it's a central backbone or a central axis of the global funding markets, is because it performs these very deep fundamental role in allowing the dealer process to take place.
But as this article explains, the dealers started saying, we don't want to do this deep fundamental role. And we're going to ask why and answer why later. But good news, someone else stepped in to do that for them, the hedge funds. Now, for people who do not watch Making Sense, the date would not seem important to them. Early 2018 is when this rally in hedge funds stepping forward to pick up this basis trade began. But for people that do watch Eurodollar University, they know that the fourth Eurodollar crisis really began to manifest in early 2018. There were early rumbles, more rumbles, more rumbles. Sometime in the first half of that year is when it was definitely on. We knew it was on. And so do you have the numbers, some of these numbers that come from this study? Do you have those handy? Or if not, I can read them out.
No, I don't have them offhand here, so.
Okay, so the study done by Daniel Barth and R.J. Khan, and they're both from the government. One is from the Board of Governors, Federal Reserve, and the other one from the Treasury's Office of Financial Research. And you said this was a true and valuable deep dive, and they had access to data that you and I do not have access to. And they noted that in December 2014, the total hedge fund treasury exposure was $851 billion. Okay. By the end of 2017, it was $1.06 trillion. So 3 years, 25% increase. Then by 2019 of September, it was up to $2.02 trillion. 21 months, 90% increase. Because the dealers were stepping back.
Yeah, there was arbitrage to be made, and of course the hedge funds took care of it. And what we're really talking about in terms of the dealer, money dealing activities, is that essentially the dealers offloaded their warehousing duty to the hedge funds for whatever. I mean, we'll get to that in a minute. But what happened is that, look, especially the government was selling more treasury paper. Foreigners were selling them because the dollar short, as we talk about in Eurodollar universities, foreigners were selling treasuries. And the dealers said, we can't take anymore. Now, why they can't take anymore, we'll get to. But they got to their limit. And because there was a financial incentive, that also, gives us a sense of what's going on with the dealers if they're leaving free money on the table. And that the hedge fund system picked it up because there was free money for them to take advantage of.
What might it all mean? You asked that question in your article. The authors of the study answer it, and then I'm going to ask you to translate it into English. Here's what they said. First, as a result of constraints on dealers and limits to arbitrage, an equilibrium basis can emerge in which the return on holding a treasury note to delivery in the futures market is higher than the bill rate. Second, hedge fund participation in the basis trade is larger when treasuries are more costly to hold and as demand for futures contracts increases. Third, basis traders are exposed to margin constraints and repo market illiquidity, which in times of large treasury sales can exacerbate pressure on dealers. What are their conclusions about?
There's a couple different things here, and I think what I focus on is what they said: costly to hold. Mm-hmm. Why are dealers saying we don't want to hold any more treasuries? Now, the too many treasuries people out there said, well, that's because there's too many treasuries, and the dealers don't want them because these things are poison. That's not the case. What we're seeing here is that dealers are saying, darn it, I really want these things because there's a basis trade that can fund this warehouse. I can make free money here. All I need to do is go long the treasury and I can make free money. I can't. It's not that they didn't want the treasuries, it's that they were constrained. Now, some people would say that's the SLR and, the surcharges that go along with it.
There's 2018?
Yeah, exactly. But I mean, there were regulatory balance sheet constraints that are due to regulations. And that's, as we talk about this all the time, we've talked about it since early 2018, that dealers are constrained by their perceptions of liquidity and volatility, that those negative, Eurodollar squeeze type factors had prevented them from taking on what was essentially free money. All you got to do is have the balance sheet capacity to hold a US Treasury that's funded in the repo market. That's all you got to do. And the dealers said, we can't do it. We have to let the hedge funds do this for us because we're constrained through other means and other reasons. Now, regulations, sure, they raise the cost of balance sheet capacity, but that's not the final factor when dealers are putting together their balance sheet designs. If they're constrained, especially if they're changing their constraints, that's a risk perception. In early 2018, to us, that made a lot of sense because not only is rising risks consistent with dealers cutting back, that's why the risks are rising to begin with, because the money in the Eurodollar system is dealer capacity and balance sheet constraints. So the idea of this basis trade being offloaded, the warehousing duties being offloaded to the hedge funds, is entirely consistent with dealers growing more and more constrained for risk perception reasons, balance sheet space becoming more and more precious, which is the other side of monetary tightness in the modern system.
And is that where you felt the paper went astray? Because you say that brings us to last year's Judgment Day or month, and that's where you said you felt their paper went astray, is they didn't focus on the dealers. Is that your
Yeah, they had. I mean, look, they did yeoman's work up to that point in describing the basis trade, where it came from, the fact that we've seen it back all the way back to LTCM and all this. They went into very painstaking detail to prove all of the major points in the basis trade, who was doing what. I mean, really good stuff. Putting together, through analyzing the price changes and which treasury is cheapest to deliver in the futures. I mean, they went through any number of details that you look and you say, this is really good. And the problem I kept having with, I read this a couple times. The problem I kept having with is, wait a minute, you guys are focusing on the wrong part of the story here. You're burying the story. You're not. I mean, it's the hedge funds. It's the least interesting part of all this. It's the dealers, as we talked about. Why is this thing happening to begin with? And this paper was entirely focused on, let's talk about the hedge funds and what they're doing and what that may have represented as far as the after effects of last March. And what they were not saying, let's be clear, they were not saying that hedge funds taking on this increased warehouse duty role was responsible for the repo market messes and the treasury market mess in March of 2020. What they were saying was that because the repo market got into a mess, because the treasury market screwed up, this created another problem because the hedge funds were doing all of this warehousing offloading. And again, it's like, wait a minute. Why do you care about what comes at the end? Shouldn't we care about all the stuff that's at the beginning? Why was the treasury market blowing up? Why was the repo market a mess? Why were the hedge funds involved in this anyway to begin with? And it all comes back to the same thing, which is what they're avoiding: dealer constraints. And I think there's a couple reasons why they avoided that topic. Is number one, first and foremost, is they don't really have any good handle on viewing the entire monetary system as it is through the lens of how balance sheet capacity, dealer capacity in particular, is the motivating, primary, animating factor in pretty much everything. So they did a good job focusing on the hedge fund aspect of it, put that stuff together. But really, the headline here is what we talk about all the time is, look, this is very much what we see here in this basis trade saga is extremely, it's corroborative, it's confirmation of what we've been talking about all the time, which is dealers are constrained, bad things happen.
Jeff, this is my last question, but it's completely unfair, as we've already been talking for some 30 minutes, and it seems like this will require a long answer, which I'm not going to give you a lot of time for. So if it is an unfair question, then just, if you have any summary concluding thoughts, let me know. But you end the article saying, and to make matters worse, it all depends upon the haircut leverage opportunity provided by the safest instrument. I simply cannot adequately describe just how profound and profoundly unsettling this is. Can you adequately describe that right now?
No, I think I really can't. I think I was actually, that was not a rhetorical flourish to end the article. It was actually saying, I don't think I can adequately describe that because, look, what we're talking about is things that are legitimately correspond to safe assets and safe, repo safe markets. And here we see how they're being used in the sort of the opposite way in order to just keep the system going. Right, because that's the only way that hedge funds could take on this warehouse opportunity because dealers were so constrained, and it's profoundly unsettling because, like, wait a minute, we're kind of hanging by a sliver here, only because there's this quirk that makes sense, but in a very different context and a very different opportunity or a very different sense.
Any final concluding thoughts, or shall we wrap it up there?
No, we can wrap it up there. Again, to me, it's just amazing that here this wonderful, pretty extensive, comprehensive academic investigation of a very important thing, except they focused on the wrong part of it. It's incredible in one sense. I mean, it's tremendous work, but incredible in how that they sort of, the point just flew right over their head. Ladies and gentlemen, when you're walking along and merrily minding your business and then come across a red line, do you cross it? No, you don't cross it, because we all know that you don't cross red lines. But in the financial markets, in one of them at least, there has something of a red line that has developed over many years now. And where is the market? Well, it's deep into crimson red, well beyond the line, and that's what we're going to talk about next. But first, this.
From Eurodollar Enterprises. Friends, do you direct the Treasury Ministry? Do your political masters expect foaming asset prices? Are you unsure how to produce lasting froth? Then a box of Bath Suds from Eurodollar Enterprises is for you. Yes, practice blowing bubbles in the gurgling luxury of your freestanding clawfoot tub. Find the perfect mix between liquidity and hot air with our capital markets foam formulation. Our bubble brew line comes in currencies, commodities, cryptos, and collectibles. Blow them all! Orders received today will come with a fussy central banker, typically retailing for the price of hedge fund general partner, absolutely free. Simulate the political arena trying to blow it in the presence of an erratic technocrat. Don't blow it, not without Bath Suds. New from Eurodollar Enterprises. Central banker swimsuit not included.